Hello, welcome to Capital Sensei. Today we're going to dive deep into the mind of a true investment legend, Anthony Bolton, by exploring his masterpiece, Investing Against the Tide. We'll unpack what it really means to be a contrarian investor, how to find those hidden gems the market has overlooked, the critical importance of judging a company's management, and the psychological strength you need to go against the herd and win. We genuinely try to answer questions whenever we can, because let's be honest, this stuff can get complicated. So please, drop your questions, your own investment stories, or even your mistakes in the comments below. Creating a community where we can all learn from each other is the best way to get smarter together. So, who is this Anthony Bolton guy, and why should we listen to him? Imagine a fund manager who for nearly 3 decades, from 1979 to 2007, took a fund and delivered an average annual return of 19.5%. That's not a typo. 19.5% every year, on average, for 28 years. That performance turned 1,000 pounds into 147,000 pounds. The man is, without a doubt, one of the United Kingdom's most successful investors, and his weapon of choice was a philosophy called contrarian investing. The core idea of investing against the tide is right there in the title. It's about swimming in the opposite direction of everyone else. Now, this doesn't mean being difficult for the sake of it. It's not about buying a stock simply because it's unpopular. That's a recipe for disaster. Being a contrarian, in Bolton's view, is about developing a well-researched, independent opinion that differs from the market's consensus and having the courage to act on it. Think about it like this. Imagine 2 restaurants on the same street. One has a huge line out the door. Everyone on social media is talking about it, and it's impossible to get a table. The other is quiet, half empty, and has been around for years. The market is telling you the first restaurant is amazing, but a true contrarian doesn't just join the line. They do some digging. They might discover the quiet restaurant has a classically trained chef, sources incredible ingredients, and the food is 10 times better, but its marketing is terrible. The contrarian eats at the quiet restaurant, enjoys a fantastic meal for a fair price, and knows its value long before the crowds eventually figure it out. That's the essence of it. Bolton's entire strategy was built on finding those fantastic, underappreciated restaurants in the stock market. He looked for good businesses that were temporarily out of favor for reasons he believed were short-term or misunderstood by the majority of investors. He was buying quality on sale. The first step in this process is having what he calls a differentiated view. A differentiated view means you need a concrete reason to believe that the thousands of other smart people in the market are wrong about a particular stock. This isn't a gut feeling or a hot tip from your uncle. It's the result of hard, meticulous work. You have to become a detective. While most investors are reading the same quarterly reports and analyst notes, the financial equivalent of reading the restaurant's menu, Bolton was doing something more. He advocated for what's called primary research. This means going beyond the public documents. It means talking to a company's competitors to see what they really think. It means talking to its suppliers to see if orders are picking up or slowing down. It might even mean talking to former employees to get a sense of the company culture. You're looking for clues that don't show up on a spreadsheet. You're trying to build a mosaic of information that gives you an edge, a reason to believe the story is different from what the headlines are telling you. This kind of research helps you answer the most important question. Why is this stock cheap? Is it a genuinely broken business, a value trap as they're called? Or is it a good business going through a temporary, fixable problem? The market often throws the baby out with the bathwater. A whole industry might get bad news, and every stock in that sector gets hammered, even the really well-run companies. That's an opportunity. Bolton looked for those babies in the dirty bathwater. Of course, finding a company that seems undervalued is only half the battle. You need to be sure it's actually cheap. This brings us to the second pillar of Bolton's approach, a relentless focus on valuation. He was a fundamental, bottom-up stock picker. This means he started his analysis with the individual company, not with big predictions about the economy. He wanted to know what a business was worth, and he would only buy it if he could get it at a significant discount to that intrinsic value. I know terms like valuation can sound intimidating, but the concept is simple. If you were buying a house, you'd get it appraised, right? You'd look at what similar houses in the neighborhood sold for. You'd estimate its potential rental income. You do all this to figure out what the house is truly worth. You wouldn't just pay whatever the seller is asking. You want to buy it for a fair price, and ideally for less than it's worth. That's all valuation is. It's figuring out the price tag of a business. Bolton used all the classic tools. He looked at the price-to-earnings ratio, which is like asking, how many years of the company's profits would it take to pay back my investment? A lower number is generally better. He looked at the price-to-book ratio, which compares the company's stock price to the value of its assets if it were to be liquidated. He was a big believer in looking at cash flow because profit can be manipulated with accounting tricks, but cash is king. It's much harder to fake. The goal was always to find a margin of safety. This is a concept from the godfather of value investing, Benjamin Graham, and Bolton lived by it. Buying a company at a discount to its intrinsic value provides a buffer. If you're a little bit wrong in your analysis, the cheap price protects you from losing a lot of money. And if you're right, your potential for profit is that much greater. It's like buying that $100 watch for $60. Even if it turns out to only be worth $90, you still made a profit. One of Bolton's favorite hunting grounds for undervalued gems was in turnaround situations. These are companies that have been through the ringer. They might have been losing money, losing market share, or just generally failing. Most investors wouldn't touch them with a 10-foot pole. The news is terrible, and the stock chart looks like a ski slope. But Bolton saw these not as disasters, but as potential opportunities. A turnaround is like a great sports team that's fallen on hard times. They've been losing for seasons. The star players have left, and the fans have given up hope. The tickets are cheap, but then they hire a brilliant new coach. This new coach brings a new strategy, instills discipline, and makes smart trades. Slowly but surely, the team starts winning again. People who bought the season tickets when they were cheap are now sitting on a gold mine. Bolton looked for that new coach in the corporate world. The catalyst for a turnaround is often a change in management. A new chief executive officer comes in with a clear plan to cut costs, sell off unprofitable divisions, or launch an innovative new product. This is the inflection point. Bolton's job was to identify these potential turnarounds before the rest of the market caught on, before the team started its winning streak and the ticket prices went up. He understood that the point of maximum pessimism often represents the point of maximum financial opportunity. When everyone else is selling in a panic because of bad news, that's precisely when he would start his research. He was looking for signs that the business wasn't dead, just sleeping, and that something was about to wake it up. This could be a new product cycle, a change in industry regulation, or most importantly, new leadership. This brings us to what Bolton himself has called one of the most crucial factors in his success: assessing the quality of a company's management. For him, Investing wasn't just about numbers on a page. It was about betting on people. You can have a great product in a great industry, but if the people running the show are incompetent or dishonest, you are likely going to lose money. So how do you judge management from the outside? It's part art, part science. Bolton would meet with hundreds of management teams every year. He was looking for several key traits. First, honesty and integrity. Do they speak plainly? Do they admit to mistakes? Or do they always have an excuse? A management team that blames the economy, the weather, or anything but their own decisions is a huge red flag. Second, he looked for alignment with shareholders. The best way to ensure this is if the managers own a significant amount of the company's stock themselves. If their own personal wealth is tied up in the success of the business, they are much more likely to make decisions that benefit all shareholders, not just themselves. They have skin in the game, as the saying goes. They'll think like owners, not like hired hands just collecting a paycheck. Third, he needed to believe in their strategy. Did they have a clear, credible, and coherent plan for the future? Could they explain it simply? Or was it full of jargon and wishful thinking? Bolton wanted to see a realistic path to creating value. A great manager can articulate where the company is going and how it's going to get there. He often said that some of his best investments came from backing management teams he trusted, even when the business was facing significant headwinds. Now let's talk about the hardest part of being a contrarian investor. It's not the financial analysis. It's not the research. It's the psychology. It is incredibly difficult emotionally to stand apart from the crowd. Human beings are wired for social conformity. When everyone around you is panicking and selling, every fiber of your being will scream at you to sell too. When everyone is euphoric about a hot new tech stock, it feels terrible to be the one on the sidelines. Bolton recognized that the biggest enemy of the investor is often themselves. The emotional roller coaster of fear and greed is what causes most people to buy high and sell low, the exact opposite of what you should be doing. Investing against the tide requires immense emotional discipline and a strong stomach. You have to be comfortable with being uncomfortable. You have to be willing to look wrong in the short term to be right in the long term. Think about the dot-com bubble in the late 1990s. People were buying shares in companies with no profits, no revenues, and sometimes no real product, just because the stock price was going up every day. The herd mentality was in full force. To be a contrarian then meant selling those stocks or refusing to buy them and looking like a fool while your neighbors were bragging about their paper profits. It was painful, but those who held their nerve, like Bolton, were vindicated when the bubble inevitably burst. Bolton's success was as much a result of his temperament as his intellect. He had the conviction to stick to his analysis, even when the entire world seemed to disagree with him. He understood that the market is a pendulum that swings between irrational exuberance and unjustified pessimism. His job was to buy during the pessimistic swing and sell during the exuberant one. This requires a level of patience that is very rare. Interestingly, while Bolton was a fundamental investor at his core, he wasn't completely against using charts, or what's known as technical analysis. This might surprise some people, as fundamental and technical analysis are often seen as two opposing religions in the investment world. But Bolton was pragmatic. He used every tool at his disposal. He didn't use charts to decide what to buy. The fundamental story, the quality of the business, its valuation, the management had to be there first. That was non-negotiable. But he would use charts as a secondary tool to help with timing and to understand market sentiment. For example, if his fundamental research told him a stock was cheap, He might look at the chart to see if the price that stopped falling and started to stabilize. This could be a sign that the selling pressure was exhausting itself, suggesting a good entry point. He also used charts to confirm his thesis. If he believed a company was turning around, he wanted to see that reflected, eventually, in the stock price starting to trend upwards. If it didn't, it might be a warning sign that his analysis was wrong. He saw charts not as a crystal ball, but as a window into the psychology of the market. They provided a visual representation of the fear and greed that he was trying to exploit. Knowing when to buy is hard, but do you know what's often even harder? Knowing when to sell. Many investors fall in love with their winning stocks and hold on for too long, watching their profits evaporate. Others sell too early and miss out on the biggest gains. Bolton had a disciplined framework for selling, just as he did for buying. He had three main reasons to sell a stock. The first and most obvious reason was when the price rose to a point where the stock was no longer cheap. He bought a business because it was on sale. Once the sale is over and the price is back to or even above its fair value, it's time to cash in and look for the next bargain. The original reason for owning the stock is gone. It's like the quiet restaurant finally getting discovered. Once there's a line out the door and prices have doubled, the value proposition has changed. The second reason to sell is if your original investment thesis turns out to be wrong. This is a crucial point. A good investor must be able to admit when they've made a mistake. Maybe the new management team wasn't as good as you thought. Maybe a new competitor came along and destroyed the company's prospects. Whatever the reason, if the facts change, you must change your mind. Holding on to a losing stock out of pride or hope is a classic investment error. Bolton was ruthless about cutting his losses when the story changed for the worse. The third reason to sell is simply finding a better opportunity. Your capital is finite. You should always seek to have it invested in the most attractive opportunities available. If you own a stock that you think might return 10%, but you find a new, deeply undervalued stock that you believe could return 30%, it makes perfect sense to sell the first to fund the purchase of the second. It's about constantly upgrading your portfolio. In the later editions of his book, Bolton added a very candid and insightful section about his experience managing a fund focused on China after he had officially retired. This part is incredibly valuable because it shows that even a legendary investor is not infallible. His performance in China was not nearly as stellar as his record in Europe, and he openly discusses the challenges and mistakes he made. He learned firsthand that the principles that worked in one market don't always translate perfectly to another. He underestimated the complexities of corporate governance in China, the influence of the state, and the difficulty of getting reliable information. It's a powerful lesson in humility and in the importance of understanding the specific context of the market you're investing in. It proves that there's no magic formula. Constant learning and adaptation are essential. His struggles in China don't diminish his legacy, they enhance it. They show that investing is a process of continuous learning, and that even the best can be humbled by the market. It reinforces his core message: you have to do the work. You cannot just apply a simple template and expect it to work everywhere all the time. Each investment case must be built from the ground up, with a deep understanding of the local risks and realities. So how can we, as regular individual investors, apply the wisdom of Anthony Bolton today? We don't have a team of analysts or the ability to meet with hundreds of CEOs, but the core principles are timeless and scalable. First, cultivate independent thought. Stop chasing hot stocks you hear about on the news or from friends. Do your own thinking. Start by questioning the popular narrative. When a stock is universally loved or universally hated, ask why, and then try to find evidence that contradicts the consensus view. Second, be patient. Contrarian investing is a marathon, not a sprint. It can take months or even years for an undervalued stock to be recognized by the market. You will go through periods where your portfolio is underperforming, and it will test your conviction. If you don't have the patience to wait for your thesis to play out, this style of investing is not for you. Third, focus on what you can control. You can't control the economy or the stock market, but you can control your research process, your valuation discipline, and your emotional reactions. Build a checklist for yourself. What do you need to see in a business before you invest? What's your definition of cheap? Under what conditions will you sell? Having a process protects you from making impulsive, emotional decisions in the heat of the moment. Fourth, read a lot. Read annual reports, industry publications, books, and news. The more you understand about business and different industries, the better you'll be at identifying real value and spotting nonsense. Bolton was known for his voracious reading habits. Knowledge is the foundation upon which a differentiated view is built. You have to arm yourself with information to have the confidence to go against the tide. And finally, start small. You don't need to bet the farm on your first contrarian idea. Find a company you believe is misunderstood and undervalued, and take a small position. Track it. See if your thesis plays out. Learn from your successes and, more importantly, from your failures. Every investment is a learning opportunity that sharpens your process for the next one. Investing against the tide is not a simple path. It requires diligence, intellectual honesty, and a strong character. It's a philosophy that runs counter to our basic human instincts. But as Anthony Bolton's incredible track record demonstrates, the rewards for those who can successfully master this approach can be extraordinary. It's about finding clarity in the midst of chaos, value where others see only risk, and having the unwavering courage to back your own judgment. It is, in the truest sense, the art of thinking for yourself.